I think the model works at scale. I think the part that breaks actually sooner than the economic model, like even if you're managing billions of dollars, I think the model works and you can do really well. But I think that what breaks is the brand and the attention to detail. If we get to the point where we have thousands of pre-seeds, where we are actually the first investors, the hardest part for us, and I think we will get there, but I think the hardest part will be how do we continue to be a brand that people love and want to work with, is like they're the best. Like when they decide on you, they're the best. And actually, someone who's done a really good job at that is Sequoia. Whenever they invest in something, everyone wants to invest in that company. But if you go to Crunchbase, Sequoia has thousands of investments. They're louder about the bigger ones. But like, a seed round type of thing from Sequoia, like there's been a good amount. I think I forget the latest, but I remember it was like 1,500 or 2,000 investments or something like that. It's like, that's still a good amount of companies and they have a really good success rate, but they've managed to not really dilute their brand in doing so, which is fascinating.
Welcome to The Peel. I'm your host, Sergio Novak, founder of Banana Capital. Today's guest is Ed Lando, co-founder of Pareto, where he's been an early investor in over 25 unicorns, started and incubated a dozen companies, and was recently named the most active angel investor in the world, according to Crunchbase data.
We are not passive. We're not waiting for people to ping us. We're sort of actively hunting.
Our conversation gets into his angel strategy, lessons from starting and investing in over 1,000 companies, trusting your intuition, navigating hype and substance, and why Ed didn't raise outside capital.
I think this model that we're doing actually scales to managing billions of dollars because...
He also breaks down his playbook for incubating companies, what most people get wrong, advice for hiring your first true employees, and why he doesn't think incubating companies is actually a good strategy.
I have gotten so much criticism from investors for this model that we've done for a long time.
Plus, he shares the biggest differences he sees between the US and Europe.
Several of the people we work with in Paris work harder than a lot of the Americans that I know.
A quick thank you to Ben Cambier, Rohit Bandange, and Stan Coppin for their help brainstorming topics for Ed. A reminder, I publish 2 episodes of The Peel every week, exploring the world's greatest startup stories, just like this one. Tune in next week for a conversation with Matt Mullenweg, co-founder of WordPress. Now, let's talk to Ed. Ed, how's it going? Welcome to the show.
Good to see you.
Yeah, excited to do this. So I think this kind of came up. You were featured in one of my friends. He did this report on the most active angel investors in the world. Lenny Rachitsky, he put it out. We'll link it in the description for people. And you were number 1. So I think that's probably where, for a lot of people, that's the first time they kind of came across you. What's kind of the story with all the angel investing?
Yeah, thanks for having me. So the story is, I've been building startups since I was 18. I got into college. I grew up in France. I got into college. I went to Penn, and I taught myself how to build websites and apps because I wanted to build my own things, and because engineers would not respect me and my friends if we didn't know how to build our own things. And built some things. Got into YC when I was a senior in college, and went through that. It was a lot of fun. Built a couple companies even before that when I was an undergrad. But had a few smart people already kind of like around me that I wanted to bet on. And so quite early on, just starting taking small bets on them, and then it compounded. Usually, hopefully, it's sort of like having customers where if people enjoy working with you, they refer other folks. And I found that impressive people tend to know other impressive people, and I found that's a great way it's been a great way to meet at least some of the best investments I've made.
Yeah, that's fair. I think when you think about most VCs, people probably think that they're super loud and active. You kind of think of like the A16Z approach, or like a media company. You've kind of done the opposite, and it sounds, maybe you just explained why, but can you just kind of talk through why historically you just haven't done much PR and how you think about it?
Yeah, I've had this discussion many times with a few good friends, and I think there's been this debate about like whether or not to be loud or to be quiet. There's some people, obviously, if you go on Twitter, X,
I'm guilty.
there's some people, and I'm sure it yields a lot of great things, and even when Lenny sort of did that feature, I didn't expect it. It came out of nowhere, and definitely I got a bunch of great opportunities out of it. So that's why doing a few more of these. But yeah, over the years, I've never really focused on doing PR or having news, and I don't know how newsworthy it is to invest in companies.
Yeah, exactly.
But I've also found that like the best folks that I've met have been someone who I know who sometimes says like, gosh, like this person is like the most impressive, relentless person that I know. I would bet on them no matter what. And it does work. I guess when you get more marketing or PR, it sort of helps. But often, the sort of compounding has worked in itself. Where I backed a lot of companies now with Pareto, and so we just get an interesting sort of base there.
Yeah, it makes sense. For me, I kind of accidentally became an influencer. Like I was just kind of trying to get a job in VC 8 years ago, and it's kind of turned into what it is today.
It's the beard.
Yeah, I think the thing that is kind of interesting about it is it's not like somebody says, "Oh, just because Ed had a good tweet, like I'm gonna reach out to him or I'm gonna like let him invest in my company." But if you were to say to somebody else, like, "Oh, hey, you should meet my friend Turner. He's really good at this stuff. Like, check out his Twitter or listen to his podcast," then the founder might be like, "Oh yeah, this guy seems pretty legit." Like, it just kind of makes you easier to introduce to people, but you still got to do the work of like actually contributing, or maybe at a minimum, like not messing up the company when you invest. So
Totally. No, and this debate is still ongoing. And there's many examples of people who are very successful who are quiet. And obviously several of them, even you or I might not have heard of them. But there's some people who have no internet presence and who've been part of incredible companies. And there's some people who, are very, very loud. And the latter sometimes obviously get access to great opportunities because they are top of mind. So I am sort of tending towards the being a little bit louder might be worth it these days.
yeah, I think it just depends. Like, what are you good at? Like, if you're a really good writer, you should probably put your writing out there, right? Like, if you're writing something internally to your team, or like there's like some new model, like Claude Sonnet, 3.8 comes out or whatever they're going to name the next one, and you have a good, interesting breakdown or take about it, or like you tried it out and like no one's really written about it yet, and you throw it out there on the internet, a lot of people will see it, and like you did that anyways, like to like your team or in the group chat or with friends. It's like just throw it up online and it might be helpful for people, and it kind of builds your brand, your reputation, however you want to think about it.
Totally, and it's funny you say that. One of the selfish reasons why I want to do a few more of these is that I love to write, and I'd love for more people to read what I have to say. So, we'll see.
What are you going to be writing on, like Substack or?
I have a Substack, and also I'm slowly becoming a LinkedIn influencer, which is my major claim to fame. But I think it doesn't matter. Like I repost the same thing everywhere. I've never been that good at optimizing it. But as far as like what I like to write about, it's sort of a mix of thoughts and musing on startups, but then also, frankly, musings on life. When I was an undergrad, apart from some working on apps and websites, I actually thought that I wanted to be a novelist. And I just love to write. I love reading. I love philosophy. I love thinking about the world. So, trying to share those things.
All right, we'll throw out links for people to find you in the description. They can read along. Um, what so this is probably a question that would come up if somebody is more attuned to like you need to be loud to get deal flow. Like, what have you found works best in terms of having inbound deal flow come in, or maybe it's outbound deal flow when you're more quiet? I think you kind of got into a little bit, but can you just kind of talk through how that would work?
Yeah, I would think about it as far as like the beginning of a process, right? Where let's say you're just starting off investing, just simply asking yourself, who are some of the most impressive people I know from where I studied, where I worked, who do I believe in? Let me try to find a way to work with them or back them if they're building something. And then usually, if you do a couple of those, again, at some point, those people will meet other people who they find interesting, or they will hire other people who work there for a little bit, and then those people will leave and do their own thing. And so I very much believe, and we can talk about hiring later because we spend a lot of time building companies these days, but I very much believe it's a similar approach to sort of like you go to the people you know well versus, let me go ping folks. Of course, there's a lot of investors who do the strategy of pinging people on LinkedIn or pinging people on X and sort of sniping people who are interesting and reaching out to them with an interesting message. That can work for sure. One of my first good investments, by the way, was I read about this French team that was building a consumer mobile app.
I know where you're going with this. Yeah.
I was, I have a story there, but there was, I was writing for the Huffington Post, whatever that meant, but I was proud of it. This was in college, and I reached to them. I was like, hey, I want to cover you guys in the Huffington Post, and I used that as an excuse to meet up with them, and I ended up investing in them. So I do believe in a little bit of the hunting too.
What do you find yourself investing in today? I think I saw you tweeted, or it was a LinkedIn post. Can't remember which one, but you said you're doing like a couple a week at this point. So what are you kind of looking for on the investing side? And what's interesting to you right now?
Yeah. What is interesting to me in the investing side is very industry agnostic. It's sort of I just want to back impressive people who are dropping out of school or who are quitting their jobs, and ideally, I want to be the first investor in those people. And that's what we want to do with Pareto. So we're chatting. We're going a lot of campuses. We're chatting a lot of people who are graduating or dropping out of school, or sort of like fairly young folks who it's their first startups, and then also folks who are like leaving their jobs. And I think partly is because I definitely also take part in rounds that are a little bit more established and with people who've already proven themselves out. Um, and that's the sort of more consensus bucket of what we do. But I find that compared to other investors out there, this is a more unique thing for me and for the Pareto team to do.
Yeah, I feel like it's more gratifying to like back someone, like the very first investor, and they like crush it, and you're like, it's just kind of fun. Like it's way more fun to me.
It's fun and you feel more useful, and like one example that comes to mind is like, you know, have developed a really great relationship with this guy, Keon, who runs Nucleus. Nucleus Genomics. It's like a cool company. It's Keon 23andMe. We met him through a mutual friend, and we sort of like co-led the seed with him at the pre-seed. And Keon at the time was an undergrad at Penn, and he has great family, but his parents, I think, as immigrant parents, didn't want him to sort of leave school and do this, and we offered him funding while he was still in school, and that allowed him to drop out. And our friend who sort of co-led this with us, shared like I think there was a story of like the even footage of Keon's reaction when he heard the news, like on his security camera or something at home, just like
Oh no way.
screaming in joy. Yeah, and so I think when you can actually be the first person who bets on people, you're definitely much more memorable than hey, this top fund is leading around a seed. Do you want to put in 50K? Like I think that's great, and you can still make money that way. But you're less useful in that way.
Yeah. So then how did you make the transition from it's kind of your, I don't know, angel investing, quote unquote, if you want to describe it that way. You still kind of are an angel, I guess, but you have kind of like a fully fledged fund and strategy. Just how did that whole transition happen over the past 10 years? And maybe a way to frame it is like, yeah, for you or like advice for somebody else trying to do it.
Yeah, yeah. So we're very kind of like we have a strange approach where we don't really have a fund. So a couple of years ago, I was at like 450 investments or so. This was really just me as an angel. And it started becoming too much for one person to sort of take care of, even helping people with intros, signing docs,
Yeah, just doing the K1s, like the taxes.
anything. Yes, it was becoming overwhelming. It was not enjoyable. I was having panic attacks. We could talk about that, but it was not pleasant. Um, and I became friends with someone in New York, who sort of like started, investing in some companies with me. And then we were like, hey, why don't we put, some capital together in a structure that we named, Pareto. The name essentially was sort of from the idea that I'm obsessed with, which is that of power law in a sense, where like, we can go into that later, but like you can back 1,000 companies and it's really sort of one, hopefully, you hit sort of one Google and one will return like 1,000 times over. You could do well with like, let's say 100, but you will do sort of incredibly well with one. We decided to pull together some capital into one vehicle, and which allowed us to hire like one or two people to start and to simply just have a little bit more leverage. And so Pareto, I worked with that partner for a couple of years. Now it's back to being just me, sort of funding Pareto. So Pareto is like a sort of super angel vehicle, if you will, that I fill up once in a while. And we have a couple people working with us, two great folks, Ben and Jules. And together we cover a lot of ground. We are in almost 1,000 companies to date. We are not passive. We're not waiting for people to ping us. We're sort of actively hunting. We're essentially the first investors. We've preceded almost 200 companies, and we actively help them raise more money. Like in Nucleus's case, we put in a six-figure check to start, and then we helped them raise, a couple $1 million seed round. I think they raised a couple million from Founders Fund, and then they raised a Series A from 776. They've raised like more than 20 million. We were the first investors. Kian's an amazing guy. I think we were definitely, important to his trajectory. And like we're trying to find more people like that where we're the first to back them.
Yeah, I remember that's talk about anti-portfolio. I know we were talking about that a little bit earlier. That's that one's in my anti-portfolio.
Well, it's doing great, but it's never over till it's over. But yeah, we have a ton. I mean, we've missed a ton of things too. So no worries there. By definition, the world economy is pretty big. So
So it sounds like you kind of like structured this thing, and you set up this like, okay, this is like a dedicated strategy, but you didn't go and raise a more traditional fund like everyone else. Like, what was your thinking about keeping this like a little more under the radar, your own thing, versus the more traditional model that people will do?
It's a luxury too, right? It's because like partly, I've also helped start some other things and have been able to sort of sell some shares along the way, and so like recycle some capital there and have some capital to invest into companies. So it is a luxury. Obviously, if you can invest your capital, it's there's a lot of benefits to that versus investing other. I think the downside, by the way, even if you have some capital to invest and so on, and is that we've often felt more capital limited than other funds. Every day these days you're reading about a new $600 million fund that closed or a new $1 billion fund that closed. We're not there yet. Maybe we will be one day. But like, there are many cases where like, with Ben and Jules, we're like, we wish that we could put more money into this company. Even in cases where we put 100K, we're like, we wish that we could have done 500K or whatever it is, or $1 million. But, we have an active strategy right now of like when some of our investments get a little bit further along, we sometimes sell a part of our stake, even if we believe a lot in the company, because it allows us to have money to invest into other companies. But so it's not even like a deliberate strategy thing. It's more about I'm a very impatient person,
Okay.
and over the years, some really nice people have been like, Edward, you should meet this LP or that LP, and I've met with some of them, and I've actually liked some of them, but I found their process to be too annoying to sort of go and try to raise a fund and sort of manage it for now at least. And I've also found that there are a lot of them, not all of them, a lot of their sort of questions are not that interesting. Essentially, like if you go to a lot of LPs for early stage, who invest in early stage funds, if you say, hey, we're only investing in like agriculture tech companies that use robotics with like an AI thesis in, the United Kingdom, they'll be like, cool, that's a very specific thesis, like let's run that by our
Investment committee.
we can sort of sound not dumb if by sort of like pitching that, or these days like all these AI funds or crypto funds. But if you tell them you should back me because I have good taste in people and because I will sort of work harder and help them more, they can't sound smart to their investors. And so yeah, frankly, the requirements to sort of raise a fund early on were frustrating, and so I decided to take this route. And now it's getting to the point where we have enough compounding internally that it's unclear whether we will ever need external capital, but we'll see.
Yeah. So then, what was your decision making then on? You took like your entire net worth and just put it all into this extremely risky and illiquid asset class that, I mean, I'm sure like 99.9, maybe most listeners would be like, oh yeah, this makes sense. But like most people in the world would be like, that's crazy. What was just the thinking process of doing that?
Yeah, and by the way, I don't even know if this disclaimer is useful or necessary, but like obviously this is not investment advice.
Okay. Yeah, true.
This is not investment advice. But look, like in my case, I've always been a little bit crazy, like risk seeking, for better or for worse, and so I have often over the last few years had a let's say liquid to illiquid ratio personally of 1 to several hundreds.
Fair. Yeah.
That is essentially what my internal sort of finances look like, and with our stuff. I think sure, it is risky. Obviously, we invest in a lot of companies, and so it's sort of across a lot of different people. And it's just like this is what I do. I don't really do other types of investing. I don't really do public markets investing. I don't really do real estate investing. I don't think I understand that, or I've never really looked into it. Or, I went to Wharton. I took some of those classes. I'm sure I'd be like okay at it if I tried to do it, but I don't think I have an edge there. I like making early bets on people and sort of having an intuitive sense for people. And I think I'm good at it. And we'll see. It's been about 10 years, but it seems to be working, and hopefully it'll keep working. And frankly, I think that people like Ben and Jules are also really good and have become a lot better. So I've had the luck of attracting some great folks, and I'm not that worried about it. But yeah, I would say 90+% of my 95% or more of what I have is invested into what we're investing in, and also in what we're building, which we can talk about later. And I sleep very well at night thinking about that. There are other things that keep me up, but not that.
Yeah, that's fair. I mean, for the record, I'm in a similar boat. Like pretty much the vast majority of my net worth is literally in all my banana funds. And I mean, my wife is always like, Are we okay? Like, is that a good idea?" And I'm like,
It sounds like you have a great wife.
Yeah, yeah. I mean, she's awesome, but and she's like she's on board with it. Like she trusts me with it and everything. But a rational thing would be like, be a little bit more diversified. Like in the past, I've like owned real estate, but when I made the jump into venture, I literally sold. I had two houses. I had one I lived in and a rental. Sold it, cashed out, and went all in. Which I mean, I feel like you kind of have to do that if you're going to be in this business or like this realm. Is like you kind of got to be risk seeking and you got to believe in yourself. And you know, I don't know. That's all you can really do.
Yeah, well, no, I think in the traditional wisdom, there's been so many books and written about money and making money, and there's been a lot of podcasts, and everyone has an opinion. And obviously, there's some people who are really great at it, like Berkshire Hathaway and others, and you can kind of learn from those. Um, it seems like diversification doesn't actually work that well, and it seems like, and the people who actually do very well tend to initially make it from like kind of one or two big things. And then, over time, again, with this sort of like pre-seed type model, you don't have to pre-seed that many Ubers or Googles to return everything 1,000x over, hence the power law idea. Um, but but yeah, it seems like it's actually worth it to concentrate your bets. And what we're doing a little bit more of occasionally is writing slightly larger checks. So we've done a couple 7-figure checks into things when we really know people well, and when we sort of have a very strong point of view. So we'll see if it pans out. I have no idea, but it's worth the try.
Yeah, I mean, I think there is a thread of truth to that because I've seen studies where this is like public market stuff where relatively liquid assets and mature businesses or whatever. They say if you have like a public stock portfolio of like 20 companies, that is you get pretty much like 95% of the benefits of diversification. And as you keep getting more and more diversified, it doesn't really give you that much. But then you limit kind of your upside because you miss out on the big winner, sort of. It's the same thing you see in venture, but I do think because the way that we're investing in companies that basically burn a shit ton of capital and like the whole point is they're super risky and they'll likely not work. You kind of got to say, okay, maybe 20 is like not enough. Maybe you should, expand the scope a little bit. Is 30 a good number? And like that's the bar, or like 30 per year, or like per vintage, or however you want to think about it. So, I mean, I do think that, and then to your point, you're right. Like you get one thing. Like if you have 5% of your portfolio in something, and that one position is 100x, that will 5x the whole portfolio.
Yes, yes, yes. No, the math is really interesting, and I think about this a lot. And again, not investment advice, but like, let's say if you compare like public markets to private markets, and let's say you have hypothetically, so 20 public stocks, right? 20 public positions, and let's say you have $2 million to invest in total, and so you put 100K into each one of them. And unless in some cases, right, you've had crazy streaks over the last few years with like Nvidia, and other companies kind of behaving like crazy, private market companies. But usually, I mean, there's been exceptions, but usually in public markets, you don't really get 100x, 1,000x type of things. You have gotten many anomalies recently because the markets have been crazy, but usually you don't get those things. So if you do like kind of hit a winner in public markets, and let's say you get like a 5x, which could be great, you 5x 100K, which is awesome. And then on the rest, maybe you get plus or minus like 5 or 10% for each one of them, or whatever it is. The net effect on your 2 million invested is not going to be that much, right? Versus let's say you put 100K times 20, like into 20 different companies, and you buy sort of a significant stake early on because you're sort of preceding the company.
Yeah, they're starting the business and you own like 5% of it.
Right. So let's say, like a couple, several of them fail because that happens. Some of them do well. We find that, several of them like will do like a 5x or 10x or something like that. So you'll actually like make more money already than you've invested. And it just takes a lot of time. That's the problem. And then, and then let's say, you get very lucky because 1 in 20 chances. I mean, it's to find an outlier is pretty amazing odds. But let's say you get very lucky and you hit like a mega outlier and you kind of like, 100x, right? Um, you sort of end up with like a $10 million position there just with that one thing, right? With dilution and other things like that. So these sort of power law effects in venture or for this early stage thing are very powerful, where you can, I guess, in a sense, you can both diversify and have very sort of large concentrated positions.
Yeah, the one way I think about it too when explaining to people, they'd be like, "Oh, just how awesome would it have been to just invest in NVIDIA when he was starting the company? Like, just go meet him earlier." Like, it's obviously very much easier said than done. But like, yeah, that's basically what you're doing, right? You're just going and meeting people when they're starting generational businesses, and you benefit from it.
Hopefully. And then the crazy part about Nvidia or about other companies like that is, and even Amazon, is that some of those companies went public pretty early. And so if you had actually just bought those companies when they went public, you would have captured most of the upside. And then you of course have stories of like amazing investors like, Masa at SoftBank, who I think is incredible and has a lot of ups and downs. Who I believe, there's an interview where like, he sort of jokes with Jensen Huang about having sold a lot of his position in Nvidia at the wrong moment. And so you have, that the life of a great company is decades. And so for better or for worse, you're going to have moments where you're going to buy and sell probably along the way. And I think it's impossible to time it perfectly. So in my case already, it has been the case that I have looked like an idiot for selling some things. So I backed someone early, and then I sold something, and I sort of made some money. But then there was another sort of 10x or 100x afterwards. So that will inevitably happen more.
Oh, you had 100x once after you sold?
Yeah, like there's a company that I backed super early where sort of, I mean, I have a couple of those, but where sort of, I bought like, I think 10% quite early. And, I sold some and sort of, I think locked in essentially like a 25x or 30x already, which is pretty great. And reinvested some of that into other companies. So who knows if you compare the compounding there. But that company then went on to appreciate, another 10x, and then maybe now another like, 5 to 10x. So we'll see. We'll see. It happens, and you never know if you were right or wrong until the true sort of end value of the company, because we'll see. Yeah.
I mean, at least it's your own money. You're staying in the game. Like, you keep going. I mean, I feel like you think differently is when it's your own capital versus someone else, and whether that's you're riskier sometimes, you're a little bit more risk averse because you're like,
Well, no, and look, and I was chatting with an accountant friend of mine recently, who sort of was telling me that there's a lot of sort of VCs at top funds who, no matter what, every year make, if they have the interest of their carry in the fund, for the good years, they'll make a couple tens of millions of dollars, just based on sort of like the management fee and the carry and everything, regardless of their performance. And so,
you don't have that luxury. You got to like actually make money.
right. So in their case, like, I don't know if they care about cashing the thing and making the 1000x or whatever it is. I think they don't mind, overpaying for the Series A or Series B and only getting, a couple X, because they'll get into the brand name and then they'll keep attracting more LP money, and then they'll keep fees off of that. So it is in many cases a different game.
Yeah, I feel like the game that maybe the game that you're playing is backing good founders, and maybe the game that other people maybe fall into is attracting capital, like attracting LP capital.
Exactly. No, I think the game I'm exactly is backing good founders, actually being a good partner to them, and making money by actually making good investments, which is an interesting comparison to some of these other models.
Yeah, I think at this point I forget if you mentioned this, if I read it somewhere, but you backed like 25 unicorns at this point. Is that the number?
Something like that, yes. But I think that number, a lot of numbers are misleading in general. Like for example, I could have bought my way into 25 unicorns at a $500 million valuation for each one of them, and then say that I backed. But a lot of those I actually did back very early at sort of the seed stage. And then the second thing is that's not the only thing that matters. Like in certain cases, me and then Pareto, we've gotten into companies where very early, and we're now sort of marked up, I don't know, 100x or 200x, and the company's not even, well, 100x, the company's not even like a unicorn yet. And so in some cases, our best multiples are actually not in companies that are unicorns, because we got it so early.
Interesting. Yeah, I think that can be the beauty of investing in like out of favor categories, like CPG, for example. I know you have this one company as well. Is it called Catalina Crunch? Is that how you pronounce it? Is this an example of that?
It's an example, yeah. Very good friend of mine. Sort of. I was friends with him back in the day. We sort of overlapped a little bit in school, and I've always found him to be brilliant. Several of the other people who knew him were like most impressive person of our year. Worked as a quant researcher at AQR, like really good at math. Used to be like a national chess champion, and he initially wanted to start an auto insurance company. And back in the day, I was even like, we were hacking on some websites together. I thought I was maybe going to like start a company with him. But he was doing the auto insurance thing. He needed to raise a couple million for it, as a first time founder. which was a lot of money, I don't know, 8 years ago, and compared to some of these AI raises, but it was a lot of money 8 years ago. And he's brilliant, but he wasn't the most sort of vivacious fundraiser. He doesn't sort of like overselling, and so he's not able to pool his capital together. And then he just had a total 180, and decided to work on something that he cared even more about, which is he happens to be diabetic, and he could not find cereal or cookies or snacks that he could really enjoy. And so he decided to start his own brand of keto cereal, and he started baking his own cereal in his tiny little kitchen in the Lower East Side of New York.
Okay.
And then he needed a little bit of money for it. And a lot of the people we've been talking to are like, okay, look, we could have invested in, a quant from AQR to do an auto insurance company. I guess that narrative would make sense to our LPs, it makes sense, whatever the story, but like you making cereal, like what's the connection there? And, again, not to sort of toot our own horn too much, but I was just like, this is the same person, I'm investing in the same person. So I had the luck of teaming up with him early, got to invest in a very low valuation. And, it's the company's, doing north of 100 million in revenue today, profitable. He's built it into this thing you can find in every corner store. And I think it's just the beginning. But he's a beast. And that's an example of, a lot of the sayings that people say have some truth to them, even though they sound banal, but like, it's an example, you're just backing a person. And I know several people who are very intelligent people and who are VCs, and they're very sort of clear theses on markets, but they've still passed in some great seed investments because the companies looked very different from one month to another, and it changes shape, and then they miss the opportunity. But yes, that's one example where being an angel in something, early on, can actually sort of yield incredible returns, even if it's not like an Uber-sized company.
Yeah, well, even in CPG, like if you listen to a way that most early stage investors will talk about CPG and why it's so hard, it's the math. Like it is the numbers. Like the numbers are really hard to get right. Like whether it's the CAC or like your logistics costs, whatever. And he's a math genius, right? Like he's good at understanding numbers, and he's going to go and tackle this category. Like obviously, you almost need like some taste and like some design and maybe some other skills there. But that's the part that a lot of people get tripped up on, is like the math on those businesses.
You're right. And actually, maybe the fact that he is a math genius, to use your terms, like probably has helped them think about it as an actual, like, as an actual business. And sort of they did a great job expanding with retail instead of like spending too much money acquiring customers online. And he's always been super rational in looking at all this stuff. And for a while, some of the early folks who invested, were a little bit impatient with him, being like, come on, you should move faster. There's other players who are spending more online, growing faster. And didn't matter. His strategy worked. So that's another topic we could talk about. But I have seen some really smart people build companies in different ways, and not all of which I initially agreed with. And so I've learned that there are many ways to skin a cat.
Yeah, I mean that's a good topic to dig into. Like, how would you? I guess I'm not really sure what you're referring to, but like any other examples that you're thinking of that you've seen?
Yes, I think that like I tend to bias, like I try to be perhaps less and less opinionated as I go, but I tend to bias towards like a certain way of building a company. Like I spend 95% of my time these days helping build stuff, not investing. So we can talk about that at some point. But I like the sort of speed and getting traction quickly, and kind of a couple of the things I've been part of have grown really fast, almost from day one, and have gotten traction immediately. And then there's another company that I've been involved with for five plus years now, 5.5 years, in like a B2B software company, which is slowly compounding and starting to sort of add a lot of new users every day. And I think there's a shot that it could be the next Figma. But I have pulled my hair out a lot over the last few years, because I've been like, why can't we grow faster? And it's been a difficult product to build, and it's not a trivial way to acquire customers. So as opposed to I was a kind of early investor in Misfits Market, like a grocery company, online grocery company. I sort of helped get it off the ground with my friend Abi, and who runs it. And that one grew really fast.
Yeah, you said it was 18 months to get to 100 million revenue run rate or something.
Something like that, yeah. So like that was an example of like, if you think that every company needs to look like that, you might be right in some cases. But there are other models out there that would not sort of align with that, including some of these sort of complicated software companies, and including some deep tech companies, which I believe OpenAI took a very long time until it sort of got that crazy traction, right, when they released ChatGPT. So they don't all look similar. I think there's some principles that are universal across them, though.
Yeah, I mean, I think even Facebook, if you go back to kind of the early days of Facebook, it wasn't the fastest growing social network. And I mean, they did a lot of things that you might say, I mean, it's probably why they succeeded, but at the time it's like, why are you only letting college kids join and only kids at Harvard? And then like, I think they just limited like you need to be in high school, like a high school too. Like they like limited the growth. But today it's like, you'd be bragging if you said you invested in Facebook back then, but it didn't look obvious at the time. But they were making really intentional product and company building and like growth and all those different decisions that ended up playing out into like, I don't know, is it $1 trillion company now? Something like that?
It is, yeah, it's one of them. But you're right. Like there's for every company I've found that I've seen, there's kind of non-obvious things that you do along the way that are kind of surprising.
How have you found any maybe like um ways to suss that out, or like how have you decided like when we talk a little bit about investing, we're going to talk more about like building companies and incubating stuff. Have you found anything that you've been able to like pick up on, or like when do you decide like, oh, this might seem like a bad decision from the outside, but like internally I think we're going to do this because of a specific thing? Like we might be growing slower, or I mean that's usually the thing. It's like, oh, it's slower growth, but it's maybe the better decision long term.
It's a good question. I mean, I have much more of an opinion on this, on the things that we're building. When we invest or when I invest, I'm a lot dumber, less sophisticated, and I'm like, I like this person, I like this team, I have a good feeling about them. Sure, let me be the first investor, and that's usually how we sort of operate, sort of, and so I think being naive and a little dumb has worked. And in fact, if we ever talk about the companies we passed on, we probably should have been dumber and said yes to more. So
Okay, yeah, maybe that's a good segue. We were talking a little bit about anti-portfolio.
but just to finish, on the building thing, like it just depends. Like we're actually kind of building something fun and like social right now, and one of the main product people that we have on this new company is very opinionated because this product was very much kind of his brainchild, and there's certain things that we could do to try to grow faster, like have you invite your whole address book and force you to invite people in order to use it and stuff like that. And the very reason why for which we're doing this product is against that. And so we're trying to do things that are not an experience that we wouldn't want, because we're sort of building this product as a counter to a lot of the other social things out there that we don't like.
So would you think about this as like a growth first retention? So maybe going back to the Catalina Crunch, like he was growing slower, but he was like building a good product that people are going to keep using and like building customer affinity or something like that, or like defensibility, like better margins.
I think you would be better at answering that question than me. And again, I'm just a sort of useless investor in the company. He's actually built the company, but he. My understanding was that like you can spend a lot of money sometimes to acquire people online. It's sometimes it works. It's gotten more competitive. It's depends on the channels. It's unclear the quality of those cohorts and the retention. And then also, it got more competitive, right? I think that in e-commerce, you could acquire people for a lot cheaper in like the early 2010s, when some of these companies were scaling, some of these sort of golden days of e-commerce, especially in New York. And you could, the mattress companies, whatever, if they were selling a mattress for $1,000 online, they could acquire a customer for a couple $100. And so if you literally immediately pay back your CAC and then you can reinvest it, well, you're also, unless there's like a lot of returns, you're getting paid back on day one, and you're more than paid back on day one, and then you can just reinvest it into more Facebook.
That sounds like a VC's wet dream right there. Like that sounds incredible.
And it was right, but then of course other people, whether it's in that category or others, other people figured out that you can find another product and just sell it online. We tried to do that with my friend. We had we were selling candles online and sheets and stuff like that, but it just becomes more commoditized to source these products. You can hire a cool Brooklyn agency and slap a cool brand onto it, run Facebook ads, and then it becomes more commoditized. And then it's sort of the definition of perfect competition. So you have to find other channels through which to grow, including retail.
Do you have any common patterns or mistakes that you found yourself making, like reasons that maybe you could talk about specific examples in the portfolio, in the anti-portfolio?
Yes. Yes, there's a couple that come to mind. I don't obsess over them that much. I think, thankfully, I have not passed on the next Google yet, or maybe I haven't. I just don't know. But I well, now I just say yes to everything, so we're not passing anything anymore. Just, just joking, but we there's a couple like I passed early on like OpenSea, and I remember meeting one or two of the founders at a coffee shop in person in New York, and I didn't understand what the hell they were talking about and what an NFT was.
I don't think you're alone there. I think a lot of people may still don't get NFTs.
And I think they were raising at like somewhere like I don't know, 10 or 8 or 12 or $14 million valuation or something. And like at its peak so far, I think the company was worth like 10 billion, right? At least in private markets. And so what is that, 1,000x? And you know, I think if you look at the background of the team, they're super impressive people. And so if I had just adhered to what I say, which is you just sort of back people, even if you don't fully understand what they're doing, especially if you're writing a small check, I probably would have been an investor in that company. Or there was another company I met with early on, Headway, in the mental health space.
I've heard of it. Yeah.
And I think they mostly kind of focus on like B2B mental health now, and they've done really well.
It's like software for therapists and stuff.
Frankly, I'm not even sure anymore, but I think that I'll look it up after. But I met with a founder in person again. I think these in person ones are tough because I was like, it's you get more information than from a phone call. And so if you think that you're good at reading people, this proves for that thing. But met with him in person. I remember we walked around, I think like Union Square or something, and smart founder from Stanford. He wasn't the most kind of like loud, aggressive person, which is maybe what I was filtering for, like sort of force of nature, obvious, aggressive person. He was a little bit more subtle. And for some reason, I did not invest. That company I think is a couple $1 billion company. And there's other examples there. I mean, I think that kind of a non-obvious pass, sort of like not quite a company, but it's whole like back when crypto was like taking off and I was living in San Francisco, there were some friends of mine who were kind of like early investors in like Ethereum or Bitcoin. And I did not pay like that much attention to those things because I was in the mindset of I'm looking for people. I need to invest in people. I wasn't looking for I need to buy this coin, and that coin is actually the company. And so that is certainly a couple 100x at least that I did not participate in. And perhaps one last example is I think I did a good job in San Francisco even back in the day of making my way in the same room as people and meeting people. And I met with Olaf from Polychain early on, and I believe, if I remember correctly, that I had the opportunity to invest in the GP of that fund, which again, in my mind, I'm not in the business of investing in the GP of a fund. I'm in the business of sort of investing in companies early on. And I think that GP position would probably be a couple 100x at least, if not more. So I think just, what I learned from it, I don't know if you were going to ask that, is keeping an open mind about what exactly the kind of interesting opportunities are, because not everything looks the same. And to a hammer, everything looks like a nail. And then also paying attention to like the strange things that are happening in the world and where kind of like the very nerdy, intelligent people are spending time, if that makes sense. And I think I've learned to do that a little bit more.
Yeah, I mean that does make sense, and I definitely would have asked that. So I think you answered it pretty well. One interesting thing you said is you said the phone call or the Zoom call versus in person, and you said that can throw you off. I feel like most people will say, "Oh, meeting in person is better," but it sounds like maybe.
No, I think it's better. I was more criticizing myself there, where I met them in person. So I could have if I had done a 10-minute call with one of these companies, maybe it'd be easier to forgive. Like I didn't get the full thing, but in both of these cases, I met with them in person, and so clearly my in-person radar was off, and that is the thing usually that I trust the most. My close friends, and the people I work with know that I rely on intuition for a lot of my decisions, investing, building, life decisions. And I find usually my intuition's correct, but in those cases, something was wrong. And so interesting to calibrate the model.
Yeah. Okay. That's fair then.
Might be too much information, but I think you can always learn a lot from your parents. Essentially, like my dad is a journalist, and so he's a very cerebral person, sort of very nerdy in a charming way, but like can spend hours writing without interruption, just entirely focused, and can spend hours painting. Very sort of talented in many disciplines. And my mom is very different and very sort of impressive in her own way. She's extremely intuitive and a very sort of good social creature. So if she's in a room, she can kind of like the energy in the room, read everyone, charm everyone, and she immediately likes, dislikes, trusts, doesn't trust people. And I think I've inherited. So I've certainly inherited that from her, and I've inherited, I think, the love of writing and kind of intellectual curiosity from my dad. But yeah, I think even my parents sometimes have been wrong in some of their analyses, and I think perhaps less wrong than me. But I think I have noticed that in myself that even your strength once in a while can be off by a little bit.
Yeah, that makes sense. Actually, Ben on your team was telling me that you have like a pretty unique relationship with your parents, where I think you, I think you teach a class, or you'll go to speak at in a class or panels, conferences, and your parents actually come and watch. Like that's pretty incredible. Like, is that true?
Yeah, we're very close. I'm very lucky in that way. We grew up. I mean, they had me a little bit older. My mom had me when she was 42, and my dad was 52 when he had me. So they had me later in their lives. And for my mom, she never knew she was going to have a child. Like that was her first and only child, and so I think she valued that a lot. And quickly, she actually was an entrepreneur as well, but she retired pretty quickly and decided to focus on spending time with me, which was amazing for me. And my dad as well, had a lot of flexibility in what he was doing, was already kind of retired. And so, when I was 6, for example, they took me for a year out of school around the world. And we've traveled to 70 countries together. And I was sort of, I have half siblings on my dad's side who I'm close to, but I was essentially brought up as like an only child in a sense. And sort of, yeah, they taught me, school during that year, and it was certainly great. But yeah, I'm very close to them. They sort of like startups and entrepreneurship a lot, and they will sometimes come to some of these talks that we give on campuses, and then sometimes as well. We're building a couple new companies right now. My dad in particular loves to come hang out at the office. We have an office in Paris, and just hang out with the team, see what they're doing when they're tinkering with AI. He's obsessed with AI. He keeps recommending new books to me.
Oh, that's cool.
Yeah. So we have a great relationship.
Man, that's awesome. So he's probably, you said he had you when you were 50, when he was 52. I'm assuming you got to be at least 30. So I'm assuming your dad is in his 80s, right? Just hanging out at the startup office.
I'm 32. Um, yeah. My father is like incredibly intellectually voracious. I think he reads like almost a book a day, and he is yeah, he's much better read than me. And he's often the one saying, Edward, you have to read. Like the other day, he was like, I just finished the book from the founder of DeepMind on AI. He's like, you have to read this book. And I'm like, okay, Dad, I will. I need to answer these 300 emails, but I will.
Yes.
And he gets upset at me because like the next day,
Yeah, he's got a new one.
I just listened to this 2-hour podcast, by this person on like tech, on robotics. You should read about it. I'm like, okay, I haven't gotten to your book, but sounds good. He's just like an absolute, he devours content. And so, yeah, very impressive.
Well, if he's listening right now, I'd just like to say hi. Thanks for listening.
I hope he is. I hope he is. Hi, Dad. And I will read the books that you recommend.
Maybe what you could do is you could chat GPT him. You could use AI to summarize the stuff. That could be the thing.
Yes. Yes. Although I refuse, I admire, I think AI is actually very cool and useful, but I refuse to use AI to write because I love to write. And I don't think that it will write better than me, but maybe I'll be wrong.
Yeah, I'm kind of in a similar position with it where I don't know. I don't really know how to explain my relationship with AI. Like we've had, I think the two guests before this, we've had a guy named Mike Murchison at Ada. He's kind of, it's like this AI powered customer service product. Kind of the idea is it's like an AI agent that just kind of lives in your Slack and your email and all your customer support channels. And it's like a team member. Like it's a true AI agent that's on your customer support team, and you work with it.
Yep. we invested in one of those, which hopefully is better and which you should use instead. But yes, that's like that.
Okay. Yeah, well, and so we had a really interesting conversation just about like all these different ways he's just seeing like AI is changing software, and it's all super interesting, and I do kind of get it, but I'm also like specifically with writing, like I'm definitely the person who like I enjoy writing, and it kind of feels like it's hard to give it up to someone else to do it, and you feel like you're still better than it, if that makes sense. I feel like there's some areas where yeah, like coding, I feel like it's like an objective thing. Like I feel like if there's a specific thing, like you must follow a rule, and there's like the structure, and you just like know when the AI does it, and it just like matches your bar. But for kind of these qualitative things, like maybe writing.
We're working on a robotics company right now, which I'm very excited about. And people have like kind of a lot of the general public loves to have a bleak dystopian view on automation. Like the robots are coming, they're going to take our jobs and all that. And like I have a lot of respect for people who do difficult jobs in general. And I think that like there's some people, the way they do their jobs is better than any automation, and some people, and a lot of people for some tough jobs like don't really like them that much. And so, for example, like one example is I find, I don't know if you've ever had a case where you're in a car and you're in an Uber or something, and your driver is not very good. Like they're not paying attention. They're texting.
Trading stocks.
Or in some cases, they're trading stocks, or they're like watching a movie on an iPad. And like, I can understand that that's like a very tough job. And in a couple of cases, I just politely asked them, hey, do you mind, like, I don't feel safe. Can you please like focus on driving? But like that happens. And I get kind of like, I'm like, they shouldn't do that job because they don't seem to be enjoying it. I shouldn't be in that car. It's dangerous. And like, I would rather be driven by a Waymo. But there are other cases where the driver is so good at what they do that they like really care. They sort of give you incredible customer service. They drive really well. I kind of like it when they drive a little aggressively. Like, you know what I mean? Like, I think like, wow, legally, obviously, but like, like just
Yeah.
good European driving. I grew up sort of driving in Paris. So like, like sort of aggressive, like not like, just decisive, aggressive. Like, I think you probably had a driver like that. I think those are better than, sort of like machines driving, which will sometimes like, I was just in San Francisco, sorry to go on a rant on this, but like my friend picked me up in a Waymo. We were going to dinner, and the Waymo like took another 5 minutes because it did a sort of right around something that made no sense when it should have done something else. And so I don't want to live in a dystopian world where like the machine is sort of governing me in every way. But the point is, I think automation can replace a lot of jobs that people don't like having and that are dangerous and unpleasant. And that there will be companies that will help people retrain and find other jobs that are better. But I think in some cases, when people really love their craft, I'm pretty bullish that machines will not replace them, or will only augment what they do.
Yeah, I think yeah, augmenting what they do is like humans will always need to do something, and it will be. I mean, if you just think about the way that AI is changing the world, it's usually just like it makes our existing software better. So like if you go back to the 1940s, when you talked earlier about like an accountant, like the accountant would like by hand like do your books and like do your taxes. It's like you probably want your accountant using software, like using a computer and using the internet to deliver it and submit it, and not by hand. And it's like the same thing. It's like, okay, well, if just like the next wave of software is just like smart software that just helps your accountant do better and more work. It's like they should be using it.
Funny you say that. It sounds like you're almost plugging this, but we're actually building an accounting AI company with the French team.
Oh, interesting. Okay, so maybe that's a good transition. You've indicated this. You've been like dropping the hints all throughout the whole episode. I feel like we're like an hour in here, and we're like, all right, we're gonna finally start talking about this. You've built a bunch of companies, and now at this point, it sounds like you're building a ton, kind of all at the same time, incubating them. So what's the accounting or the accounting AI company in France?
I wouldn't say a ton. I have played around over the years with starting new things, and I've sort of tried to figure out what is the correct number to start, where we can do a really good job and build things that are successful. I think I've already helped start, more than a dozen companies over the last 10 years. And, unfortunately, they've not all been successful. But so have learned about I think the right number, and perhaps improving the areas that we go into and how we assemble the teams and all that stuff. But like the general overview, even without the accounting, is like we have part of our team in Paris. As mentioned, like I'm partly French. Ben, who introduced us or put us on the thread, who invests with me, is in Paris. So is Jules, and Ben also loves building. And we've had success helping start a couple software companies over the last few years. We helped start a sales tax company called Zamp, which is a much better version of Avalara, because we were using Avalara at some of other companies, and we could not believe that they were worth $8.5 billion when the product didn't really work, and it wasn't like a good experience. So we decided to build a better version. The initial product was built by this engineering team that we have in Paris that is amazing, and they're great at engineering, at product, and all that stuff. So we have a couple of other areas that we're building stuff in right now, kind of like boring and yet exciting B2B software stuff that is fairly early on, just in cool areas, like certain industries that we think deserve a little bit more automation. We're doing sort of like a software to like improve the workflow of accountants, and not that much to say about it at this point, but we're building a couple new things there. And then, as alluded to earlier, we're also building a couple of deep tech companies, which I find very exciting. We've been working in a robotics company for the last year and a half with the founder of, I teamed up with the founder of Bear Robotics, which is pretty much a unicorn at this point. We became friends about 2 years ago, and we're building essentially, in our opinion, a smarter version of the humanoid robot, which applies to certain verticals like warehouse automation, back-end automation for QSR restaurants, and things like that.
How do you balance just having so many things? It sounds like maybe there's 4 things, 5 things. Just how do you think about just balancing it all?
Well, number one, I'm not yet married, and I don't yet have children, so I think that helps. And
There
I
you go.
can essentially just I wake up, I work out, I work, and I do it again. Sometimes I'll have a nice glass of wine because I like wine.
Do you sleep? You didn't mention sleeping.
Yes, I do sleep.
Okay, that's good.
Uh, but we do have some pretty crazy hours at Pareto. But no, I think that we essentially, the answer is we have a very, people say this, but in our case, I think it's true. We have a very, very good team, and they work super hard, and it's almost like we're all, I think, quite close. And Ben, for example, helps lead several of these new kind of like software ones, and in the robotics case, like Bren is sort of the brilliant roboticist who knows how to build them, and we have other great people on our team like Annie and folks in the US. So it's the right folks on our team, and then sort of assembling great founding teams for these companies that we build. And the other answer is like, when I speak to people, I feel very lucky, with what we do. But when I speak to people who are maybe in some cases in more traditional jobs and kind of bored of them, corporate jobs, it doesn't feel like work, and a lot of these interactions I have with people are on iMessage, and, I don't really use Slack that much. And, we just sort of enjoy what we're working on. And so it obviously, some things are stressful as usual when building a business, but it just feels like, a continuation of, it's just a continuation of the day. It doesn't feel like work. And so it doesn't really stop.
Yeah, that's definitely the advice I'll always give people. Is like you should be trying to do things that don't feel like work. Like as cliche as that is, but it just makes it more fun and makes your life more interesting. Like I've had jobs where it's like you have the bullshit meetings, like you have 5 recurring meetings every week for an hour at these specific times, and you don't do anything in them, and they're just not. And your job is like you're in charge of a spreadsheet. Like that is your whole job, is like updating a spreadsheet.
It's performative. We actually have another company that for spreadsheet automation. So we can,
Okay, amazing.
but no, you're right. Like, and one of my biggest fears, like I loved where I went to school. I thought, I'm very grateful for Penn, and I went to Wharton undergrad, and it's an amazing school. But one of my fears there was like, when I was 18, I had just got into campus, and one of the first things that like my friends down the hall told me is like, oh, there's like an on-campus recruiting session for banking, if you want to come to get an internship for next summer. And I was like, okay, what do I have to do? And they're like, you got to put on a suit. So I was like, hey, I put on a suit, and I went there, and there was some banker from, I forget, one of the big banks was like, so do you want to do investment banking, or do you want to do private wealth management or whatever? And I was like, I have no idea what any of this stuff is. Like, I'm 18. I just landed here from Paris. I don't know what you're talking about. But in some of these classes, I found them very interesting, like finance and stuff like that. But in others, I was just like, I don't want to update spreadsheets as my job. I don't want, and I, as an investor also, I don't want my only point of view on companies to be the result of a sort of DCF model. I'm sure some people can do like great discounted sort of evaluations of companies and do an amazing job. I don't see what the edge is of one person versus another in that. I think that like I wanted to do something where you can actually it's a luxury, like feel very grateful, and not everyone has this luxury. But I wanted to do something where being a unique individual, you could express your sort of unique self. I think that is the ultimate goal of having a job. It's to not be replaceable.
Yeah, that's interesting. To your point about DCFs, like, I think you need to know like what the DCF looks like or will compute, but like it's not going to be any different than anyone else's, right? Like, you need to generally know, like, oh, this is what it's roughly going to look like, and to our job is probably like, oh, we just met the guy he's gonna build, or the girl who's gonna build a company that's gonna produce this DCF in 10 years. We met them and believe in them before anyone else, and like the DCF will be built in 10 years when there's actually something there that a DCF can be built on.
Exactly. It'll be built eventually when there's actually a business. And a lot of people know how to, cut and chop and analyze a business, but not many people can sort of just make it happen. There's one thing side note I'll say is, I don't know if you saw, I watched parts of the Magnus Carlsen podcast on Joe Rogan, which I thought was really cool. And because I like chess, and like you could say like, chess is a lot about memorization, and you learn openings, and it's not that original, and it's similar to like doing a discounted cash flow model of sort of a company, or writing software. Like, what's that unique about the thing? But in some cases, understanding the rules a little bit is the sort of pre-requirement for being able to innovate on those things. So Magnus Carlsen understands all the rules, and he's able to then innovate with these sort of novelty type things that only he can do because he's sort of a grandmaster of those things. So anyways, that's a sort of counterpoint for going through some of the more boring stuff initially.
Yeah, I like that way of thinking about it, because like if you know all the rules, you can know when to bend the rules and know when other people will or won't know how to adjust to the rules, or how they'll react to the rules it tells them or what it tells them to do. So
it's like a remix. You need to, in order to do the remix, you need to take the original song.
Oh, nice. I like that. Well, I'll listen to that. That sounds like I don't listen to a ton of podcasts, honestly, like as somebody who has one. But yeah, and that's actually why I started it. It's just like, I thought it would be kind of interesting. Like, you just get to meet people. Like, maybe you would have agreed to like talk to me for 2 hours and like record a conversation, like, but you just record the conversation. You just like ask people stuff that you're interested about. And you can learn things, and it's not like, oh, I have to. I guess because it's a podcast, like I do put out an episode every week, and I try to be disciplined about it and like plan stuff out. But it's kind of like you just kind of do whatever you want. Like, you can just like have whoever I want on it.
But I'm sure it's a lot of work. Actually, my dad encouraged me. He says you should launch a podcast, and I was like, it's a lot of work, and I actually think you're doing a great job at it. I don't think I would be as good or have the time to do it. So it's everything to be done well. Everything requires a lot of work.
Yeah, I think it is kind of interesting. You got to find ways to the point about bending the rules. Like the rules, are like the current meme or thing in VC or tech would be, everyone has a podcast and none of them are very good, right? So it's like, okay, well, what if you just try to make a really good podcast, right? And then you kind of break through the noise. So that was kind of my thinking. I guess TBD. I mean, I'm working on it. So
to your point, I think everything looks from the outside. There's a lot of people in the world, and there's like there's a lot, but there's not that many categories of opportunities, and like startups and venture capital are one. But like everything can look like a red ocean if you just look at it from far away. But then very few people actually do what they do well, And so yeah, I think again, whoever when you invest in a company and you actually like the person you're investing in, and you actually sort of believe in what they're doing, and it's not about the who else is investing and the social proof and the dynamics of the round, and they're going to raise their cap 2 days later because of that, but you just like
yes,
like you're actually just you like the person, you're betting them, and they're going to build a business. So I think there's a lot of secret places to be uncovered underneath the sort of veneer of red ocean perfect competition.
One framing that I use for investing, I don't know if this is true for you, and But I think about like, would I work for this person? Like if I was just looking for a job, like would I take a job at this person's startup? Like if would I be their first employee, or would I be a co-founder or something like that? Because that hits the lens of like, okay, they got to hire. Do I think they'll be able to convince talented, smart, ambitious people to work with them? But also like I'm betting my entire net worth and like my salary on getting paid and compensated by this person. Um, so then it can kind of guide like, do I think it will work? Do I think they're a good founder? Would I enjoy, or would people enjoy working with them? Do I think it's going to be a good investment? That's kind of a rough framing that I use to kind of, it's not perfect, and you think of other stuff too, but
No, you're essentially, by investing in it, you're sort of in some way, allocating part of your resources. You're in some way kind of working for them or with them, and then they'll ask you to do things to help. So I think that is it's a good magnet, it's a good filter.
yeah. What have you found? You mentioned before you guys move really fast and move quick on things. I think that's something that everyone likes to think that they do, or wants to do better. And maybe some people move too fast and do it wrong. I'm not sure, but how do you think through doing that correctly? Like, how do you move fast and be good at it?
I think first of all, my first answer is it's not as high stakes for the check sizes that we're writing. Where if we're writing, we're investing in a couple of companies per week. Some of the investments are 25 to 50,000. Some of them are low six figures. So it's still like it's not trivial, but it's not like we're not writing a $50 million check or $100 million check into a company. Um, and so we definitely make mistakes, but like the cost of being wrong is lesser in a sense. And again, sort of the cost of uh, I guess omission is greater also than the cost of commission. And so um, we can't say yes to everything, and people are surprised given our volume that we sort of say no to 90 98%, 99% of the things we see. We see a lot of things. But yeah, like I think it's just a gut feeling type of thing where I've had tens of thousands of conversations at this point, and I think Jules, well, Ben has had thousands or at this point, and so is Jules. And we don't think that much. I think it's more kind of a visceral thing. That's our pitch. If we ever raise from LPs, it's like we don't think that much. It's more like we're gonna get on. We're like, yeah, we got to do it. And like for example, the other day, Ben and Jules were pinging me. They're like, Edward, you have to jump on a call with this person. Like they met this person. I think Jules did a great job hunting him, like literally like pinging him over and over and over until he answered. And then Jules talked to him. It's like, talk to us. And yeah, he's great at that. And then he's like, Edward, you got to talk to him. And they didn't really tell me that much about it. And sometimes he does send me sort of a write up and so on. But I just got on a video call with him, and I was like, I get it. Like I was just like, I get it. He's got this sort of like killer energy that we're kind of looking for. And again, it sounds very naive, but that was the diligence. And so we're investing in him. Yeah, we just felt it. I do think what I love about it is that it is a very intuitive thing. I think some people are probably more intuitive for people than others, and some people are more, have a greater innate sort of ability, let's say, with numbers or stuff like that. I think TBD whether we're great at what we do. Again, we're patting ourselves on the shoulder a lot, but this is kind of like our approach. We definitely feel things, and yeah, I think it's kind of it's an interesting way to look at the world and at companies.
It sounds like trusting your intuition on, like, that's a good way to move faster. Is just you don't question yourself.
A little bit, but we trust our intuition a good amount. Or another example, I obviously will not name, but recently Ben, pinged me about another company or founder, and was like, I think this person's like very impressive. They say they have a lot of traction, but like, unclear. He's like, can you talk to him? Because I have an impression. I don't want to tell you too much. I don't want to bias you. And I said, okay. And so I got on the phone with him, and 10 minutes in or 5 minutes in, I messaged Ben and I was like, this person is a charlatan. And I was like, I think this person is a charlatan. And Ben was like, I know what you mean. And I also had the same kind of impression, but I'm not 100% sure. And so there are a few cases like that, because like you talk to companies early on, they're like, we have we're a team of one or two or three. We've got this cool product. Maybe in some cases we've got traction or contracts with this or that. And you're like, we're not sure, and so then the question is like, what do we do? But I just revert back to just trust your intuition.
So then how would you do it on the building side? Like obviously you've got to make fast decisions if you're working on so many things. Like do you have a framework or just like a process you kind of go through, or just like a thinking of like, okay, the way that you act fast, move with haste and speed on the execution side?
Yeah, well, thankfully on the building side, I found that, and again, we'll see if we end up being as successful as we hope we will be. But like, so we've helped start, Misfits is already kind of a couple $1 billion company at this point, and it's done great, and that's in great part due to Abby, who's running it, who's done the hard work. But thankfully, I've gotten to be a part of that, and it's been amazing. And then there's a couple other companies that I've been sort of involved with early on, or it helped start, like, Zamp is doing really well. It looks like it's on an awesome trajectory. The robotics company Kinesi is doing really well. We have others that are doing well. And we've helped start, a payments company. I helped start a company called Goody in the gifting space that I actually ran for a year and a half, which is doing really well. We're building a new healthcare company right now. So all these are like kind of different areas, but I find that it's the same thing. It's just always kind of the same thing, which is like you try to have like a pretty clear, like, thought opinion on an opportunity, and then you have an initial set of people, sort of someone usually leading like product or engineering, and people helping with operations and making sure that sort of the ship runs smoothly. And then at some point, not always immediately, but at some point, a great force driving the thing forward as the CEO. And then you have to attract other people beyond that have good chemistry with this initial set of, let's say, 3 to 5 people, and that work well and hard and that are self-motivated. And then you got to get some resources, and then you got to make some progress towards whatever your metrics are or whatever your sort of goals are. And then you probably have to get more resources. And it's essentially kind of like, it's the same thing. And it is a funny thing where there's sort of a couple different types of founders or CEOs, right? I think, and there's a few good books on this, but there's the like operator CEO, who's almost like a COO in a sense. And that person is like in every detail, and often CEO should be in every detail, but that person's in every detail, understands every line item, how much am I paying for this? What's the exact sort of like contribution margin for that? And so on. And there's kind of like the capital allocator CEO. And the capital allocator CEO is kind of like the investor minded CEO, who might be a little bit more out of the weeds, so a little bit more kind of in the cloud, but sort of understands like, okay, we need a team for this, person for that, we need resources for that, we need to sort of allocate some of our resources here. Anyways, the point is, I think it's a lot about just attracting some really good people early that have good chemistry, working together and working with urgency towards something.
Yeah, it sounds like having a good plan of attack, or like you need to know the steps or the goals or milestones you need to go to, like just the couple most important things. It sounds like maybe that's something you're hitting at too. But
Yeah, I mean, I think if we talk in a couple of years and we've started 3 or 5 billion-dollar companies, maybe I can come on another episode and I can lecture people and sort of like
break it all down. Yeah.
I can act like I know everything. I think right now, we have a couple things that are doing pretty well and that have some good momentum. And again, my what I'm surmising is that it's a lot of the same thing. Like, it's just like you want to build a company in a certain space. Sometimes we know a lot about the opportunity. Sometimes we don't. Sometimes we know about it because it's like we were using the sales tax software. It sucked. So we started Zamp. Sometimes we're like, we love automation. We think there's something incredible to do in automation. Let's team up with someone who really knows, robots, like Bren at Kinesi. And then Bren's an amazing engineer. He's great at attracting talent. I've helped build a couple of companies, and there's always the same motions of building a company. Cool. This robotics company is going to need customers. We need someone to help lead sales. We need to close some warehouses. We need to get some sort of pilot signed. We need to sort of like have people help implement this robotic solution at the warehouses. We need to hire more engineers. We need to work on the product. We need to know what product we want to build by, next week or in 3 weeks. We need to, go raise some more money. So it's a lot of the same motions, no matter what company you're working on. And obviously, investing in a lot of companies influences how we look at building companies, and building companies influences how we look at investing in companies.
Yeah, good feedback loop. Do you are there any things that you see people get wrong often? Maybe it's like lessons you've learned personally or like through investing stuff, just like maybe specifically on like the building or the incubating side, like if somebody were to ask you like, what advice do you have for me like incubated companies? Is there like common pitfalls you see people run into, or maybe that you've ran into a couple times?
I think, well, by the way, a lot of people want to incubate companies. It's really hard. Like everything that people want to do well, it's really hard and unclear. We'll see if we're successful at it.
So yeah, maybe that's an interesting way to like start the question or the answer too, is like, why should you or shouldn't you do it?
I don't think it's that good of a strategy to incubate companies, because I think it's already really hard to build one company well, and I have gotten so much criticism from investors for this model that we've done for a long time of like, we don't believe you can attract the best talent. We don't believe that you can do this, or how do you allocate your time, or whatever it is. I think the results will speak for themselves. Like if we build, our goal is to build a couple of the largest companies in the world. If we do that, then we'll have been right. Um, but like clearly, like some people, right, who are amazing and who everyone knows, whether it be Musk or others, like have helped build several of the largest companies out there. Often they've started with one big success, right, and then that big success has given them know-how, resources, ability to attract talent, ability to attract more resources from investors. So I still think the dominant strategy for someone starting off is pick something, pick an idea that you have a pretty strong opinion about, where you have some sort of specific understanding that most people don't have, and where ideally you can get traction pretty fast. Go get traction, execute, succeed, sell your company or IPO, either or run it forever if you happen to have stumbled into Facebook or something, and then either kind of hang out and become an angel investor because you've already made money and it's painful to build a company, or then go do the incubating thing. But I think almost no one can incubate things because it's really hard.
So you should probably only do it if you've if you really know what you're doing, it sounds like, or if you've kind of gone through the motions quite a bit.
I know a lot of VCs that manage billions of dollars, um, that say, hey, we want to incubate stuff, or maybe we can team up on one of them. And they're like, we could start off this company with like $5 million and or 10. And I'm like, Jesus, that's more than like what we started any of our companies with. That sounds amazing.
Yeah, that's like what we deploy in a year or 2 year period.
Yeah, but a couple of times, I've sort of explored with them, and they're so dogmatic with their way of like looking at like which type of talent would be the right caliber for the founding team. And they're like, oh, if we want to build in this space, we have to get someone who used to work at X VP of something at this. Of course, that has to be the right CEO for that. It's just dogma. It's like the right VP of this is now the perfect CEO for this new company. Instead of like, frankly, a lot of the best people that I've worked with have come out of nowhere. Like they were not the best, they were not the XVP of whatever. They were just like very hungry, self-taught folks who probably had a couple years of work experience somewhere very intense and brutal, where they sort of learned like how to work 100-hour weeks. Who are very smart and who figure it out. Like Rohit at Zamp, like came from Insight and came from like private equity and was awarded an undergrad and like dual degree engineering. And like he wasn't the like VP of something at Avalara. We ended up hiring several of those people there, and people from other kind of competitive companies. But it just to end on my rant, it's whether you're investing or building. Most people think that greatness has to come from like a pedigree place, of like, of course you have to hire your founding team from this thing. And those are the rounds that become oversubscribed very fast. And a lot of the greatest companies are like anomalies, and they come from like, who knows?
Yeah. Well, so it sounds like the importance of like the people and the team is it's kind of like shone through the whole conversation. What would you recommend? Like if I'm a founder, I'm maybe a couple founders, we're 3 people, 2 people, whatever, or solo founder, whatever. I'm trying to hire my first 5 to 10 employees. Can you just maybe talk through how you would approach that yourself, and just like what you would think through and how you would do it also?
Yeah, I've done this like 15 times now, and actually it gets harder after a while, because so the way you start, if it's like your first company, I think it's easier because you have hopefully a bunch of friends from school, from back home. Hopefully, if you went to a good school, or from your previous job, if you work somewhere with smart people, and you're like, and often I ask people this, I'm like, who would you want to hire, who who's like a good friend of yours?
Yeah, I feel like everyone has this.
Sarah from this thing and Mike from this thing are like beasts. Like, of course, I would want them. They would be my first phone call. I'm like, cool, then go bring them on. And like, usually it's like your roommates or your like best friends from this, or the person you work with at that company. And those are your like first 5 people on your team, or first 3 to 5. And then, you make some progress. Maybe you raise a little bit of money. And then so you become a little bit more real. You have a website, maybe you have a couple customers, you raise a little bit of money, and then you go ping fancy industry person. So whether, if you're building software for, I don't know, if you give me an example, you're building software for something,
Accountants or
you'd be like, well, okay, maybe someone from QuickBooks would be good, or Intuit, right? Great. So how about the VP of product from there, And like, if it's just you, first time entrepreneur, it'd be hard to hire the VP of product at QuickBooks, and unclear whether you want them. But start out by hiring your roommate, or teaming up with your roommate, teaming up with Bob from your previous job, or Jane, or whatever it is. And then get a little bit of money, get a little bit of traction, and, have maybe, the VP of product at the fancy company give you advice, and then check in with them once in a while. And then like 2 months later, they're like, wow, you made a lot of progress and what you're doing sounds exciting, and you've closed some investor capital, and I'm tired of working at a huge company. Fine, I'll join you as, head of product at your startup. And then you get the head of product of the fancy company that joins you. And then that person usually has worked with a bunch of other great people. And then you essentially get them to maybe recommend some folks, because it's great to hire teams versus only individuals. And then you kind of compound from there. But usually you don't start with the fancy person. You start with people that you know and trust, and who you've known for a long time, who are willing to grind with you.
So you do recommend the fancy person eventually once you get there?
I recommend the sort of industry person as higher number, like somewhere between, hires 5 through 10. But for the first couple of people, I recommend the sort of your good friends who you like to grind with and who you want to be in the trenches with.
Okay. How would you suss out somebody who is coming from a bigger company and figuring out would they be good, employee number 5 at this grind it out startup?
I think the most important thing is to make sure that they don't want to be only a manager, and that they're okay still being an individual contributor. I think if someone thinks I have 15 years of experience, or 18 years of experience, I'm too fancy to do the work myself, but I want to lead a team, and I want to hire people and tell them what to do. I don't think they're good for a startup. I think that the best people for a startup they might have a really good resume like that person, but they'll get their hands dirty, and then they will build out a team. So an example is, we just hired an amazing head of BD at the robotics company. And that person previously was at another company for 7 years, where he helped lead them from a couple million of AR to a couple hundred million of AR. And when he joined, our startup, which is now 18 people, but when he joined, he was like, I wanted to find out. I was like, so how quickly would you want to build out a team, to sort of give you leverage and so on. And he was like, oh no, we don't need that right now. He's like, I can do a lot of. He's like, I can build a pipeline. I can do a lot of these conversations myself, close some deals, and then we'll close some more money, we'll close some deals, and then we'll build out a team under them. So it's really the sort of, if you've seen one of my favorite movies, like Troy, like you want like Achilles to like take the beach with his soldiers, and you want Achilles to be like sitting at the back of the boat, being like, you guys storm the beach, I'll sit here. You want that sort of initial senior hire to like do the fighting themselves alongside the soldiers, and then they can scale. But that's how you sort of earn the respect, and also that's how you hire someone who's not essentially useless. Because hiring someone who's just the manager initially is not useful, and frankly, it might never be useful.
Yeah, and it's such like a suck of capital. Like, let's say you've raised $3 million and you got to pay them 300 grand a year, all in just like the cost of like salary, benefits, sales tax, like their computer, rent for the building or whatever. Like, that's like 10% of your capital. Like, you put 10% of your balance sheet on a bad hire, that can kill you.
It totally can kill you. And then of course they'll attract other people who are not that good. But I would sort of challenge you to say, like, take any successful company, very successful company, and, give me an example where the, hires number 100 to 200 are better than hires number 0 to 100, right? Or even 0 to like 20, or let's say hire. And in some great cases, there's some great companies where hires, like the team was still amazing at hire number like 800, but then like almost every company becomes kind of like diluted in a lame way when they get to thousands of hires, because they just bring on people who are more kind of bureaucratic and So it is something to be allergic to, I think. Otherwise, it end up looking like a sort of large government agency or something.
Okay, that's fair. Uh, you tweeted the other day. You tweeted, "I love AI." Well, what's the story with that?
Oh, that was just a little nod or wink to one of my best friends, Riley Opelka, who's one of the sort of best American tennis players. He he's become a very good friend. He's invested in several of the companies that we're building, and he actually kind of looks a little bit like Erlich Bachman from Silicon Valley. He's definitely a handsomer,
Oh,
taller.
really?
Uh,
Okay.
I mean, he's got the big beard. He's like a handsomer, taller version, but he loves. He when he was injured, he literally did a trip to San Francisco and went and met with some robotics companies. And this is a guy. He's a 7 foot tall tennis player. He used to be like number 17 in the world, and he would go into these startup offices to meet with them and talk about AI and robotics. And he would sort of like opine on their product strategy and so on. And the whole time he was making fun of himself, knowing that he doesn't really have much of a background to be able to comment on this. But interestingly, his thoughts and opinions are actually always very sharp and valid. But he loves making fun of himself, and often he'll call me up and talk about startups. And of course, neither of us find anything as exciting as AI. AI, of course, is the most exciting thing in the world, as we know from all the investment activity going on there.
Yeah. I feel like maybe there's like a little bit of a little bit of like humor in that response, or
Oh, yeah, yeah, of course. I think that I actually think AI is cool, but at any point in time, I think that the crowd gets excited about something, and just the number of rational deals that are getting done around the effusive excitement around this, and then there was the last thing before that, and the last thing before that is it's very funny. So yes.
so how do you navigate that? Like, or do you like have an immediate allergic reaction to whatever the current thing is, or like how do you approach that? And just like thinking about, as a founder, I mean, maybe it's good to build something that's hot, but as an investor, maybe you want to invest before it's hot. How do you manage that?
Well, as a founder, we try to build like two types of things. We try to build some things that I would say fall into a little bit of the consensus bucket, where we're like, you know what, there's a bunch of players out there. It's a hot category, but we think we can out execute everyone because we work harder, and we're more intense, and we're better at raising money. So let's just go and out execute people, and kind of some of these obvious ideas like the accounting AI thing that we're going to do, and some of these other things. It's not like a huge secret, but like the devil will be in the details, and we think they're large categories and we can out execute people. But then there's other, I also love the non-consensus things. And I think the non-consensus things, or like skating to where the puck is going to be, is where you can essentially become legendary, right? I think to OpenAI's credit, when they started working on OpenAI, people were not talking about it as much, right? And right now, I don't know, and that was like 2015 or something. But like, right now there's the equivalent in other industries. And so, for those, it's like things that we find interesting and that we care about. Like, for example, I've always cared a lot about, the quote unquote longevity space, however you might call that. And ever since I was in college, I've known that I wanted to do stuff in that space. And I've, over the years, read a lot of books, met a lot of people, and I followed, over the last 2 years, there's been a lot more attention around Brian Johnson and some Netflix shows around various longevity things. And everyone these days is doing sauna and cold plunge and fasting and being careful about what they eat, and all that stuff. But I've been sort of interested in that area for a while, and we've invested in some pretty intense like deep tech companies that are trying to help us live longer through maybe replacing different parts of your body that are falling apart and stuff like that. And like, I think they're not really getting much attention right now because they're very nascent, and a lot of people don't like to think about it or have not started thinking about it. But the people who are leading those companies are some of the most impressive folks that I've met, and it is possible that in a couple of years, they will already be able to show something, and people might be like, "Oh, I can get like a brand new organ or other part of my body or something as it's failing." Sure, sounds good. I would like that. And at that there might be a whole craze around like deep tech bio companies, and but the correct moment to do the non-consensus thing was earlier on. So I think whether you're building or investing, we definitely participate in some of the hype things because sometimes we think the hype is correct. It's almost like that quadrant, right? Of the quadrant of like consensus, non-consensus, right and wrong. Obviously, ideally, you're never wrong, but then you can either be consensus right or non-consensus right. And so several good companies I've invested in were kind of hype early on, and I got to participate, and it was great, and we did well. But several of the best investments I've made and most legendary things I've been a part of were initially not consensus.
Yeah, I think you go back. I did a presentation to my college, like presented to a finance class, and like what is venture capital, and I was just looking at some old data, and like Amazon raised $1 million at, I think it was 5 million post money or something in 1995. Like in videos, $1 million at 10 million posts or something. Facebook was 500K or something at
500 for 10%, so five posts. Yep. Mm-hmm.
Yeah, but then you go back, it's like it's not like Facebook was like a shitty company or shitty asset. Like if you looked at, like, they had a couple million users at that point, I'm pretty sure. Maybe it was like desktop only, but there was like a lot of noise around social networks, and it wasn't the fastest or like the most attractive or best looking social product or social network at the time, but it ended up being right. But it was non-consensus at the time.
And look, like without taking too much particular shots at people, like you hear about, let's say, several of the founding employees of OpenAI who leave and who start new companies, and those companies get backed immediately at a couple billion or a couple tens of billion valuation. I don't know. I'm sure I can imagine what the discussion was, which is like, this is an infinite TAM. There will be that's what was said in the room. It's an infinite
Yes, that's the most dangerous word.
infinite TAM. There will be a multi-trillion-dollar industry here with these sort of infrastructure AI companies. Even if we're doing it at 20 billion or 30 billion with no product or no traction, we still have at least 100x. And like, this is the company. It's the last company. Whatever. So we'll 100x our investment. That's probably the discussion that went in the room. I personally prefer investing in a company at a 2 cap and doing 1,000x on that with my own capital. But that's my way of investing. So we'll see. But that's what happens when you don't manage billions of dollars of other people's money.
Yeah, different incentives. You play different games.
I mean, I will say, even one day, if and when we manage billions of dollars, I don't think we will invest in a particularly frothy way like this.
I feel like your strategy does have to change though. Like if you look at like Berkshire, like Warren Buffett, like I think he's classically said, like if you put him back and you only had $1 million, like he could put up 50% returns a year, because at this point, like in order to move the needle, he has to invest in like one of the 100 largest assets in the world, kind of a thing. So it changes what your opportunity set looks like as your capital base goes up. So
It does, yes. Because if you have, let's say, $1 billion, and if you have $1 billion, and let's say you put in, 100K into a company, and you were right, and you back them early, and it becomes $10 million, which is amazing. It doesn't really move the needle that much, which is kind of a problem.
yeah, you'd have to do that 100 times to return the fund.
You have to put more capital to work, essentially.
And if you're investing 100K at a time, you have to do that, like, I don't know, 10 times a day to like invest the whole billion. And like,
But the part that I disagree with a bit with large funds is that there's always this term of putting more capital to work, because of what you said. However, let's say you buy 7 or 10% of the next trillion-dollar company today, even if you only quote unquote put to work 200K, who cares? You still, if you let's say you have capital, so you actually maintain your ownership throughout every funding round, and you end up with 7 or 10% of a multi-hundred billion or $1 trillion company. Are your investors not going to be happy that you only deployed? Think you might have to deploy more capital to prove that you have to deploy more capital. But I don't. But the answer to the thing is, I think this model that we're doing actually scales to managing billions of dollars because of the power law, because of like you essentially get 1,000x or 10,000x or more. So it can actually still work even if you keep investing small amount of money in a lot of different companies. But to give one example to support the sort of disruption of the model, like one of the other people that I really admire is Bernard Arnault in France. And I admire, of course, that he managed to succeed in an environment that's very difficult for businesses. Like, it's not at all as friendly as the US. But like the way that he started, right, is like he found that asset, right, a distressed asset with Dior, and Dior was part of like essentially like was bundled with a couple of other assets, and he took Dior, brought it back to life, got rid of the other assets. It started spinning up. It started creating cash flow, and then he got another one. And then he realized that if you had another luxury brand, there were economies of scale because you could share back in operations, share marketing, share other things. And then there was more cash flow, and you got another one, another one. Today, that group is worth a couple hundred billion. It's one of the most valuable, or the most valuable private or
I think it's public.
public companies in Europe. But he still owns like a big piece of it. And he, today I forget exactly the price of Dior originally. I think it was like somewhere between 50 and 100 million. But like today, a target of that size would be too small to be interesting to them. And so that is sort of disruption at work, where if you wanted to create the new LVMH, you could probably find a great asset in that price range for 50 to 100 million that they could not be interested in because it wouldn't make sense for them. So thankfully, there's still always a way to disrupt incumbents.
Yeah, you're almost doing like bottoms up disruption to venture capital. Like you're going at the very bottom of the market, like the first check in the smallest valuation, like cheapest, lowest end of the market per se. But and then you can move up. But I think the another interesting thing is I've heard Sam Altman's actually said, going back to the YC days, like he wishes he could back 10,000 companies a year at YC because it like opens up the opportunity of entrepreneurship. And if you're investing at a super low entry point, you have just a ton of companies like that. You just increase the basket size. You have a higher hit rate. Like you get more things that hit in the portfolio. And if you have reasonable entry points, it works. And like even like a single check at 2, 3, 4 million post in somebody that no one else believes in can return the whole fund or more, and you're doing it so many times that you will have a couple of those and it will continue to return the entire pool.
Exactly. I think the model works at scale. I think the part that breaks actually sooner than the economic model, like even if you're managing billions of dollars, I think the model works and you can do really well. Or even probably tens of billions. But I think that what breaks is the brand and the attention to detail. And I'm not commenting on anyone in particular, but I'm saying if we get to the point where we have thousands of pre-seeds, where we are actually the first investors, the hardest part for us, and I think we will get there, but I think the hardest part will be how do we continue to be a brand that people love and want to work with, is like they're the best. Like when they decide on you, they're the best. And actually, someone who's done a really good job at that is Sequoia, because like whenever they invest in something, people freak out and everyone wants to invest in that company. But if you go to Crunchbase, Sequoia has thousands of investments. They have thousands of investments, but they just like they're louder about the bigger ones. But like a seed round type of thing from Sequoia, like there's been a good amount. I think I forget the latest, but I remember it was like 1,500 or 2,000 investments or something like that. It's like that's still a good amount of companies, and they have a really good success rate. But they've managed to not really dilute their brand in doing so, which is fascinating.
Yeah, that's actually pretty interesting because someone could just say like, oh, like I know Ed and Pareto, like they invest in anything that moves. Like that doesn't mean anything to me, like as somebody else. But so you got to like uphold keep that high bar, like quality of the brand. It's like, oh, that actually means a lot.
The truth, as I said earlier, is like we pass on almost everything, but we are very active and we hunt a lot of things, and we get introduced to a lot of people. So our quality bar is very high, and I would say higher than all these accelerators and pre-seed funds and all that out there. But we just happen to see a lot of things. So you can actually probably make volume and quality work in the long term at scale.
Interesting. Yeah, I think it'll be cool to just see how it evolves for you guys because it's like probably one of the more interesting approaches anyone has. So I'm excited for it.
Well, maybe we'll do another one in a year or two, and we'll see how it's going.
One thing you mentioned that I thought was kind of interesting, you've kind of hinted at like US versus Europe. What have you kind of found differences? Sounds like you've built companies in both of them, whether it's on like the operating environment, opportunity set. Just how do you think about US versus Europe?
Yeah. Well, so I'm a little bit of both. I'm partly French. I'm also partly Canadian. I'm now also American, which I'm very proud of. So I'm a third. And we have part of our team is in the U.S., part of our team is in Europe, and some of the cliches are in fact are not true, and in fact they're kind of reversed. Where a lot of the yeah, like several of the people we work with in Paris in building companies and in investing work harder than a lot of the Americans that I know. Well, obviously, everyone works really hard on the Pareto team, but like some of the French people on our team are some of the hardest working people that we know, and they don't even do any of the stuff that people in the US do. Like they don't work out, they don't spend any time, doing all that stuff. They're just at the office smoking cigarettes and, taking Zins or something and just working.
Just working, yeah.
Do any of the wellness, sauna, working out stuff. They're just grinding. And so it's very interesting. But as far as the market, we definitely invest in some European companies, and we're finding some really cool people there. So, and same thing, can find them at low prices. And so that's exciting, and we're going to double down on that. I would say on the building side, we're building American companies. It just so happens that a lot of our product and engineering teams are in Europe. And so same thing, like there's some very, very talented people there. They're less expensive in comparison, and they tend to also be very, very hardworking, very loyal. So that's my general insight. And I definitely think that the markets are not exactly the same in the way that consumers behave. For example, like French people spend a lot less money on e-commerce,
Oh, do they really?
Yeah. Like, well, they have less money on average, but like Americans will be like, cool, like new, coat for my dog, subscription every month, every
A
month,
new coat for the dog.
like a different coat every month. It's like $150 per month. Like, sure, I'll try it. I'll sign up, and you could probably build like a $50 million revenue business on that pretty fast in the US.
Yeah, I could see like an influencer launching that, like a dog, some like cute girl, like hot girl with a dog. Yeah.
Exactly. But in France and Europe, people spend way less money online. They have less money. They spend less money. There's several, like people will be way more careful about that. So e-commerce is just trickier for that stuff. But we tend to build businesses. It's funny because like I focus on France because I grew up there. France, I think last I checked, is like around 70 million people, something like that. I forget exactly. I should know. But like Sweden is smaller, and Sweden, it's like a trickier thing because everyone in Sweden like speaks Swedish, which is like not very common at all, right? And like French is still like a pretty common language in the world. So like if you're like a French entrepreneur, you're still kind of like tempted to build for France because like France is still like a pretty big economy, and a lot of them launched there. And then they're like, let's build for Europe. But of course, building for Europe is not exactly the same thing because there's like different regulations for each country, and it's like hard. So it's a pretty fragmented, like highly regulated type of one market after the other. Versus in the US, yeah, it's just like my point about Sweden was they've had to build abroad immediately because the domestic market is not that interesting. Versus in France, a lot of people still build for France because the domestic market is like pretty big, but we don't do that. Like we only build US companies.
I can definitely see. I've definitely like heard that analogy before. Is like, the people in like Denmark or whatever, or in insert random small, like it's unique language or something. Like you're kind of forced to go global quickly. Definitely see that.
Maybe if obviously people want to find me, like they can find me on X, Edward Lando. They can, and also I'm trying to write more and more. I love to write, and maybe one day I'll publish a novel. So if you want to subscribe to my Substack, it's also Edward Lando, and it's linked in my LinkedIn. And I post what I write on LinkedIn, so maybe LinkedIn is the best thing. But yeah, thanks for having me. And again, I would say among the people listening, if my favorite time to meet people, it's not when people say, I have a term sheet for a round and we're looking for angels. Like I don't find that very interesting. Like we still do that, but I don't find it interesting. It's when they're like, I'm just getting started and I haven't really raised any money, or I'm looking for a co-founder, or I'm even looking for an idea. That is the time where we thrive because we can help people find ideas. We sometimes build companies with them. We're sometimes their first investors. That's when we're more useful and more differentiated than a lot of the people out there.
Yeah, we'll throw all the things you mentioned. We'll throw them in the description, and people can reach out if it sounds interesting.
Cool. Yeah, this was awesome. I really enjoyed the conversation.
Yeah, this is a lot of fun. Thanks for doing it. And thank you for listening. If you like this episode, please share it with a friend. If you missed it, make sure to check out last week's episode with Tommy Nicholas, co-founder and CEO of Alloy, one of the fastest growing fintech companies in New York. Tune in next week for Matt Mullenweg, co-founder of WordPress and Automatic, which powers over 43% of all websites on the internet. If you don't want to miss it, subscribe to my newsletter, The Split, linked in the description to get each episode plus a transcript emailed directly to your inbox every week. Thanks again for listening. See you in the next episode.